I own QQQ, so do millions of people. It's the simplest way to bet on big tech without picking stocks. But 3 weeks ago, something quietly changed in how this ETF works. And by the end of this video, you're going to understand why your QQQ might underperform Apple, Microsoft, and Nvidia for the next 6 to 12 months, even if those companies do fine. This isn't about a crash. It's about a slow leak that almost nobody is talking about. Let me show you exactly what's going on. First, a quick setup because this matters. QQQ is an ETF that tracks the Nasdaq 100, the 100 biggest non-financial companies on the Nasdaq. It's massive, $435 billion in assets. It's the easiest, cheapest way for a retail investor to own Apple, Microsoft, Nvidia, Amazon, and the rest of big tech all at once. Here's the critical part. QQQ is a passive ETF. That means it has no opinion. It can't decide to buy more Apple or less Nvidia. It can only mirror the Nasdaq 100. Whatever the index does, QQQ does. When a company enters the index, QQQ has to buy it. When a company leaves the index, QQQ has to sell it. No choice, no discretion. And this is called forced buying and forced selling. Normally, this is invisible. Companies enter and leave the index slowly, in small amounts. The fund rebalances without anybody noticing. But the new rule changes that. Because of what's about to enter the index, the rebalancing is going to be anything but invisible. Let me walk you through what changed. On May 1st, 2026, Nasdaq quietly activated a brand new rule. It's called fast entry, and it changes a process that's worked the same way for decades. Before this rule, when a company had its IPO, it had to wait roughly a year before it could join the Nasdaq 100. Now, it only has to wait 15 trading days. That's 3 weeks, with just 5 days of advance notice to the market. Why did Nasdaq do this? Because SpaceX was about to go public, and Nasdaq didn't want to lose that listing to the New York Stock Exchange. So they changed the rules to make their index more attractive. And there's a detail almost nobody is talking about. Companies that come in through fast entry get an index weighting 3 times the value of the shares actually floated on the market. Translation? The new company gets an amplified weight in the index, and in QQ, which means QQQ has to overweight it compared to its real public float. Now here's the question. Which company is about to use this rule first? And what does it mean for those of us holding QQQ? The answer is SpaceX. Elon Musk's company is going public on June 12th. Ticker SPCX. It's going to be the biggest IPO in history. Target valuation? $1.75 trillion. That's larger than every company on Earth except a handful of mega caps. And they want to raise around $75 billion in the offering. Now let's look at the financials because I want you to see what's actually inside. Revenue last year, around $18 billion. Net loss, almost $5 billion. So yes, this company is currently losing money, a lot of money. But, and this is important, Starlink, the satellite business inside SpaceX, is already profitable. Over 10 million subscribers. More than $1 billion in quarterly profit. The losses come mostly from Starship development, the next generation rocket. At the IPO price, SpaceX would trade at roughly 60 times forward revenue. To put that in context, Nvidia trades around 20 times. SpaceX is being priced for a future that hasn't happened yet. And one more thing you need to know. Elon Musk is keeping about 85% of the voting power through a dual-class share structure. So even though you'd own a piece of the company, you'd have basically no say in how it's run. So here's the picture. A high-growth, money-losing company at a stratospheric valuation with very limited public float, about to be added to the Nasdaq 100 in just 15 days. And QQQ has to buy it, whether we like it or not. And to buy SpaceX, the fund has to sell something else to make room. So what gets sold? The Magnificent Seven, the same names that have driven the entire market for years. Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Tesla, the very stocks most of us bought QQQ to own. Now let's get to the number. JP Morgan estimates that the forced selling could reach up to $95 billion across the largest tech stocks. But I want to be honest about what that number means. $95 billion is the worst-case scenario, based on SpaceX hitting a $2 trillion valuation. At the more realistic $1.75 trillion target, the number is lower. Other Wall Street estimates put the forced ETF buying alone between $22 and $60 billion. So the real range is somewhere between $22 and $95 billion. A wide range, but the direction is clear. Let's break down what that means for individual stocks. Nvidia could face over $20 billion in passive outflows. Apple around $16 billion. And the rest of the Magnificent Seven proportionally below that. Now, I need to be very clear about one thing. This is not going to crash these companies. $20 billion in outflows on a company with a $4 trillion market cap is less than 1% of its value. Spread over days or weeks, it's noise. The Magnificent Seven aren't going to collapse over this. But, and this is the key word for the rest of this video, there's a but. 3 of them actually. 3 quiet ways this rule hurts us as QQQ holders. Let me show you each one. Problem 1. Our fund will buy SpaceX during the first 15 days, exactly when forced buying is pushing the price up. We buy at the peak of the post-IPO pop. That's the worst possible entry timing, and we have no say in it. Problem 2. To buy SpaceX, the fund has to sell Apple, Microsoft, Nvidia, and the rest, not at their highs, at the market price of that day. So we're forced sellers of stocks we wanted to own, at no particular advantage. Problem 3. Remember that 3x weighting? It means SpaceX will have an inflated presence in the index for the first year. So our QQQ will be more exposed to a single volatile new IPO than it should be. If SpaceX has a bad first year, we feel it more than we'd expect. And here's where it gets even more interesting, because SpaceX is just the first one. OpenAI could file for its IPO by the end of this year. Last private valuation? Over $850 billion, possibly $1 trillion. Anthropic is reportedly in talks with banks. Both of these will likely qualify for fast entry too. So this isn't a one-time event. This could happen 3 times in 12 months. Each time, the Magnificent Seven gets diluted further. Each time, QQQ has to sell more of what we wanted to own to buy something new, untested, and volatile. The cumulative effect is the real story. One event is digestible. 3 back-to-back changes the structural composition of the index and of our QQQ. So if you, like me, own QQQ, what can you actually do about this? There are 4 real options. I'm going to walk you through each one with the honest trade-offs. Option A, do nothing. Hold QQQ, except that there will be marginal underperformance for 6 to 12 months. For most long-term investors, this is the rational choice. The system has handled rebalances for decades. The leak is real, but it's small relative to compound returns over years. Option B, delay new purchases. If you've got money you were planning to add to QQQ over the next few weeks, you could wait 30 to 60 days after the SpaceX IPO. Let the forced buying settle. Then resume your contributions at more reasonable prices. Option C, switch to an alternative. There are equal-weighted ETFs that track the Nasdaq 100 but don't concentrate exposure on the biggest names. They treat every stock the same. There are also S&P 500 ETFs like VOO, where the fast entry rule doesn't apply the same way. Different ETF, different rules. Option D, buy the Magnificent Seven directly. If you're convinced the real winners are Apple, Microsoft, Nvidia, and the rest, skip the ETF and own them directly. You'll pay more in commissions and taxes, but you won't be forced into any rebalancing you didn't choose. I'm not telling you which option is right. That depends on your situation, your timeline, and how active you want to be. But you should know that you have a choice. Before we wrap, here's the honest reality check. All these numbers are estimates, not certainties. Wall Street might be wrong. ETF rebalancing has been smooth for decades. SpaceX could disappoint at the IPO and make this whole discussion irrelevant. And even if it all plays out as predicted, the impact on QQQ is marginal underperformance, not a portfolio disaster. I'm not selling my QQQ, but I am paying attention. The fast entry rule is the kind of thing that changes the math quietly. You don't notice for 12 months and then realize your ETF underperformed the index it's supposed to track. Now you know, and you know what to do with it. When OpenAI files its S1, I'll break it down the same way. Subscribe so you don't miss it. And let me know in the comments which of the 4 options you're leaning toward. I'm genuinely curious. I'll see you in the next one.